All right, y'all. All right. What's up? What's up? What's up, everybody? All right. Welcome back to Stock Talk with Barack, your guy, your man, the master of the market. No, I'm just joking. I wish I was the master of the market. All right. Now, today we're gonna hit some stuff we've already went over, but that's okay, right? So I want you guys to be able to at least start going out and at least uh, hitting these key metrics to make things a little fast and simple for you guys, right? So these key metrics is what I run through real quick to see if I'm even going to consider this stock before I break it down any further, right? So, um, like I said, if you've been watching my videos, a lot of this we've already went over. We're just going to hit it up again real quick, and then we'll move on to more stuff after this video. Okay, I already have a bunch of stuff in the pipeline, and everybody's going to be looking really good. What is growth investing, right? Screenshot all these slides, right? Print them out, save them, get a folder, a binder, and save these so you have something to go to. What is growth investing? Focuses on companies growing faster than the overall market. These companies reinvest profits to scale instead of paying big dividends. That one right there, guys, is important, all right? If you go and watch any of Warren Buffett's interviews and books or anything like that, I don't know if he has any books, he probably does, but he says this all the time, right? And he owns Berkshire Hathaway. Well, he don't own it, but he ran it for years, Berkshire Hathaway. And he'll tell you, I would rather see a company reinvest its money back into the company than to give out dividends to shareholders. Now, there's nothing wrong with dividends, and there's nothing wrong with a company doing this, depending on what the company does. Okay, so if it's in growth mode, like if it's in growth mode, it doesn't need to be doing dividends. Dividends is more for established companies that have been around a long time, and they're just kind of like Coca-Cola, right, or AT&T, right? Like their growth period at the moment is kind of over with, right? But they're not going down. They're going up, but just like at a slow, steady pace at this point, right? And so then now they're able to pay dividends, and that's what keeps the shareholders happy. With growth companies, what keeps the shareholder happy is their capex, right? Their capex is them reinvesting their profit back into research and research and development, right? So the goal: buy before the market fully realizes their potential, right? If you can find a really good company that's about to take off, even if you gotta wait a year or two, but after doing your research, you feel really confident in what they got going on. That's you getting in before everybody else realizes the potential, right? Like I got into SoFi when it was under $5, and now it's, I don't know, in the 20s. So, and then that's huge, right? Because $5 stock is nothing. You can $5 stock, you can buy 1,000 of them, right? And then that $5 stock goes up to 20. Imagine 20 times 1,000, right? Versus 20 times 5, huge difference, right? So imagine all that money, people made. So, all right, let's move on. Top metrics for growth investors with simple breakdown. All right, revenue growth. That's top line, guys. Remember revenue growth. Top line means revenue. Look for consistent year-over-year growth, preferably 15 to 25% for fast growers. All right, we're really looking for that 20% or above, guys. Means the company is gaining market share or expanding demand. Earnings per share growth, EPS. That's the bottom line, guys. That's the one that matters the most. Okay, that's how much profit did they make after paying all their employees, paying their bills, keeping their lights on? How much do they get to keep, right, after all that? We want that growing 20% or greater, okay? 20% or greater. Return on equity, okay? You guys, we went over this one too. Return on equity. Your ROE, ideally 15% or greater, shows how well they turn invested money into profit. excuse me, sorry. A high ROE means management is efficient with investor capital. It means they're spending your money right, okay? Return on assets, we're looking for greater than 5%. Remember that, guys, greater than 5%, okay? For most companies, though, this can vary by industry. It does vary by industry, okay, depending on, like, if you're a manufacturing company versus cybersecurity company, okay? Cybersecurity company, you don't have a lot of assets, right? It's cybersecurity. But if you're Pepsi or something, you know what I mean, like, you have a lot of assets because you're manufacturing. So it's just, you gotta take that into consideration. Your PEG ratio, price to earnings to growth. PEG under 1 is often a bargain. Adjust the PE based on expected growth. Okay, when you're looking at the PE, I like to look at the forward PE. Okay, forward PE is what analysts project the PE to be in the future. Okay, so if the PE is 15 and the forward PE is 25, then the analysts are expecting them to have a good 12 months ahead. Okay, great tool for spotting undervalued growers. The PEG. Don't get too hung up on the PEG, okay, guys? Not for growth investing, but I just wanted to throw it out there. That way, you guys at least know what it is. 4 red flags to watch out for, okay? Revenue growing, but net losses widening. So if the top line is growing good, but the bottom line is stagnant or shrinking, then that means they're not spending their money right, guys. Okay, that means that they suck at managing their money, and just watch out for that. Okay. Stock-based compensation, unit profits. All right, is the company paying their people way too much? Are they giving out way too much money for their CEOs, and it's hurting the company? Okay. And that's another thing. The CEO matters, like, dramatically. Like, it's the CEO. You'll notice when you are in the market and you've been in a while, certain CEOs have great reputations, and for good reason. And sometimes, like, if they move to a new company, like Chipotle's CEO turned around Chipotle. Chipotle is like one of the best restaurants to own stock-wise. And so after he was done, he did his job and everything was smooth sailing. Then Starbucks was like, hey, come help me out over here. I'll give you a bunch of money. Come over here and help me. And so now, like, I don't even think it's been a year yet. The CEO of Chipotle is now the CEO of Starbucks, and Starbucks was kind of struggling. So just from Starbucks getting the new CEO, Starbucks just it went up. I mean, it's went up like 10-15% just off of that news alone. Okay, so CEO matters a lot, guys. So this is a Vertiv Holdings, Vertiv Holding, and that is ticker symbol VRT. Ticker symbol VRT, and they build data centers. They build like these cooling systems to cool down the data centers, and data centers take like an extreme amount of power, and they can overheat real easily. So it takes they have this like liquid that's like negative 300 degrees that these big chips basically just sit in this liquid to keep them so they don't overheat because of how much power they're producing. Anyhow, with the way tech is going with the AI and everything, I knew VRT was going to be a great company, right? Because data centers are being built left and right now, right? So what this company does is just in really hot demand, and they're one of the best at what they do. So, and I imagine they're gonna be doing good for a while. I would say for easily a few more years. But I got in way back here, as you can see. I got in way back here, and I mean, look at it. Like when I got in, it was like a $40. I think it was like $30 or $40, right? And right here, the high was 155, and I think it was like 30 something. I got in over here. All right, and then this one is Palantir. All right, Palantir. I love Palantir. I sold my position. I more than 10x my money on Palantir. I should have held, but anyhow, I did end up selling, and I think I dropped like 2 grand on Palantir, and that 2 grand turned into like $12,000, and so it was insane. And I got in like way, way, way back here somewhere. And then this is SoFi, and I actually got out of SoFi as well. Shame on me, but SoFi, I got in way, way back here. It was under $5, and it's now over $20. So I wrote all this out, and I wrote it out. And then I think I sold. I sold in here somewhere. I got scared. The market was tanking. Trump just got in office. The tariff talk was scaring the shit out of the market, and nobody knew how long it was going to last. So I was trying to lock in some profits, uh, before we just had this huge downfall. But the market ended up being a V-shaped rally, and if I would have just sat on my hands and did nothing, which would have been the best move, I would still be in this today. But it is what it is. You learn. It was a good learning lesson. So I'm glad I did it. I'm glad it happened, because now I won't make that mistake ever again. So, all right, guys. All right. This is the public account, guys. So I'm gonna try to go over the public account. I think every Friday, maybe every Monday and Friday, but every Friday I'm gonna go over the public account. So as you know, we added Elf Beauty. I picked up 10 shares. This is the P&L open. So this is how much we've made since we opened, since we got into these positions. Okay. So far on Adobe, we're up $25 off of 3 shares we bought. Elf, we're up $86 off of 10 shares we bought. Google, we're up $101. This is Palo Alto. They are cybersecurity. We are up $82 on that. This is T-Mobile. We're up $88 on T-Mobile. This is Toll Brothers. This is housing. They build like rich homes, like homes of like $1 million and above. And we're up 75 on them. And here's Tesla, and we are up $98 on Tesla. So total, we are up $559. So don't look at this available right here. See how it says available? I don't have this available, okay? I do. If I wanted to use it, I could. But this is a margin. So it's tallying all this up, and it's saying, basically what it's saying is I'll let you borrow $7,700 because of these here. And he's like, and basically what happens if it goes south, they'll just take all this from you, okay? And I've had this happen to me. And I had it happen to me at the worst moment. So it happened to me right around here when the stocks tanked, and they sent me a margin call, and I got this letter basically threatening, they gave me like a couple weeks or whatever to pay the bill. So I ended up having to sell out a bunch of great positions. And so like, don't do a margin call, guys. Don't. I've made that mistake for us, so you guys don't have to, okay? So you're constantly learning in this game, right? Anyhow, next course we will be going over a income statement and breaking down a company's earnings. That's going to be a really good one, guys. Really good one. The battery's about to die. All right, this is FinViz. This is a heat map. It's great. I have it for 1 month out, and you can see what stocks are hot, what stocks are cold, and so it's really good. This is the S&P 500. It's got every stock in here. It's got every category. It's really good. Look into it. Sorry, guys, I have to really speed up. And then this is Seeking Alpha. I just want to go over this real quick. My laptop's about to die, but hopefully I can get this out. All right, so let's see here. This is NVIDIA, okay? NVIDIA, and then what you're going to do is you're going to scroll down. You see here, this is earnings. See, means they're beating earnings. This was the estimated, and this is what they actually did, okay? So we want to see all beats, okay? Beat, 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 beat. When you're looking at a company, if they're not beating earnings, that's a bad investment, okay? So here's your forward PE of 38, okay? And then this is the trailing, TTM means trailing 12 months. So in the last 12 months, total of a 53, the P is 53, and they're projected to have a 38, which means they're going to be leveling out, is basically what it's saying. They think they're going to be leveling out a little bit, just a little bit. I mean, they're still growing crazy, right? Like, look at this, return on equity 115%. That's nuts, guys. Return on assets 61%. That's insane. This is where you find these numbers at, guys. Market cap 4 trillion, total debt 10 billion, total cash 53 billion. They ain't going bankrupt ever. You know what I'm saying? I want to go over more with you guys, but I gotta go because my phone's about to die, or the laptop's about to die. So anyhow, love y'all, peace out. I hope this helped, and more coming soon. Stay tuned.